Hi everyone, welcome to today's episode of the Boggs Briefing. I'm Andrew Villafranca, Director of Financial Planning and Wealth Advisor. I had a client who was talking to a friend recently, and the friend mentioned that you can't roll over an IRA into another IRA more than once in a 12-month period. This is called the lesser known rule called the IRA Rollover Once Per Year Rule. My client then asked me, is this true? Technically, yes. The IRA 1 rollover per year rule is a tax law that limits the number of times you can move from one IRA to another in a given year, and the rule was put in place to prevent people from using IRAs as a way to avoid paying taxes on distributions. However, don't get this rule confused with direct rollovers or trustee-to-trustee transfers. There's no limit regardless of how many times a direct rollover is done within a 12-month period. When you roll over an IRA into another IRA, make sure the funds are moved directly from your current financial institution to your new financial institution. If you happen to take a distribution from that IRA with the end goal of transferring those funds into another IRA, you have 60 days to deposit it. If you take another distribution from an IRA within that 60-day period, you'll be taxed on the earnings from that first distribution. The regulation applies to all IRAs you own, and that includes simple, SEP, traditional, and Roth IRAs. Here's an example. Tom has IRA number 1 with a mutual fund company and IRA number 2 with a brokerage firm. He receives a distribution of $7,500 from IRA number 1 on January 15, 2025, and rolls over that amount within 60 days to IRA number 2. If Tom receives another distribution from any IRA before January 16, 2026, then that amount would not be eligible for a 60-day rollover. However, if Tom wanted to request a trustee-to-trustee transfer between those IRAs, that transaction would be permitted. The consequences for doing this incorrectly can be severe. Taxes and penalties may apply if you receive distributions of previously untaxed dollars from an IRA, and you must include it in gross income. Any previously untaxed amounts distributed from an IRA may also be subject to an early tax penalty of 10% and a 6% excise tax for any ineligible rollover amounts that have not been removed from the IRA. So, how can I avoid this once per year trap? Well, make sure when rolling over an IRA into another IRA, you do a direct rollover or trustee-to-trustee transfer. This will ensure a smoother process with no tax headaches. If you have any questions about the IRA 1 rollover per year rule, reach out to our team, and I'll see you at the next Boggs Briefing.